Ladies and gentlemen, a very warm welcome to you. I am Sarah Lowther, and a warm welcome to today's Master Investor Gold and Precious Metals webinar. In under 2 hours, you're going to hear the wisdom of one expert speaker and 4 excellent companies. So now is a good time to turn your attention to gold. Is it a now investment, or is it a long-term store of value? Could a price in excess of $3,000 per ounce be a realistic possibility? Now, this is an interactive webinar, so if you have any questions you'd like to ask, please put them in the chat, the Q&A function, and we'll endeavour to get through as many as possible. Okay, first of all, we are joined by a very dear friend of mine who worked with me on the Money Channel and on LBC when he was known as Charles Gibson. He's now Lord Ashbourne and is Director of Content Mining at Edison Research. And I'm sure he'll have a view on where the price of gold may go and whether history is indeed repeating itself. Charles, over to you.
Sarah, thank you very much indeed, and a very warm welcome to you all, and I hope you can see me all right. And you know, I could say apologies for the change of name, but there was little I could do about that. Apologies also if you remember me as, you know, fresh-faced and youthful, and you know, what can I say? It's just a lockdown affectation. So the name's changed, the looks changed, but most of what's underneath has remained, I think it'd be fair to say, pretty much the same. So I've been a gold and precious metals analyst since 1996. So you know, I've got a bit of experience at it, and this is really just to give you, you know, what my thoughts are at the moment. So I've got a little slideshow here that I will do my best. Hopefully you will be able to see this coming up very soon on your screens. So if you could just all confirm that you can see that, or someone can confirm that they see that, that would be great.
You can see it, Charles.
Fabulous. Thank you very much indeed. So I guess we all know where we are. And, you know, the thesis of a lot of this is that what's happening at the moment, to my view, is very, very similar to what happened in the late, or throughout the 1970s, but in particular at the moment, the late 1970s. And I just want to try and ask the question about what that means in terms of where the gold price might go. Now, let's see if I can move this forward. That's the gold price. I don't think I need to dwell on that over the last 100 and a bit years. That's what it looks like. You can see that first spike in here between 73 and 83. That's the sort of period I'm talking about. And you obviously, you know, what I'm asking is what is the similarity with that spike that we're now looking at between 2013 to 2023. Just before I get onto that, I think it's worth just saying, when you're looking at gold, often, and particularly if you're my generation, you joined the market in the late 1990s, you think of as gold as, you know, perhaps a diversifier, perhaps an insurance policy, but not something you really necessarily buy for performance. And this actually is to contradict that. That way of thinking. If you look since 1967, in capital price terms, the gold price has actually outperformed the Dow Jones, and, you know, by a reasonable margin. So, you know, although you might want to think of it as a diversifier and as an insurance policy, actually it's one that has performed better than the thing that you're probably insuring against, in this case in the form of the Dow Jones. Now, I know you'll get an income from the Dow Jones that you won't from the gold price. If you want to add that in, you'll probably find that the two roughly equal out. So in total return terms, they're actually very, very similar. The other thing that's probably, you know, you could look at this in a different way, which is the Dow Jones divided by the gold price. And you can see at the moment, so you'll see in, you know, when the graph is high, then gold is cheap and the Dow Jones is expensive. When the graph is low, then it's the reverse. Gold is expensive and the Dow Jones is cheap. You can see we're actually roughly in the middle. And if you want to look at a time-weighted average, we're actually actually the gold price looks a little bit cheap relative to the Dow Jones in those terms. So historically, it's been a very, very good performer if you want to look over the long term, as well as being a diversifier, and as Sarah said, a long-term store of value as well. Now, the thing I really want to look at is as we move into this era of slightly higher interest rates and what that might mean and what the parallel is with the 1970s. This is actually just a graph to compare risk and returns. And the other thing you can see, if you're thinking of gold against other commodities, it has a fantastic risk reward ratio. So you can see the gold point there. Has it been outperformed by vanadium? Yes, it has, in what I would call the gold bull market from January 2002 to the present. Uranium is there, but vanadium, in order to get that performance, you have to take much, much greater risk. All right, uranium has outperformed it, but apart from those two metals, gold has been a fantastic performer in risk and reward terms. Now, back to the parallels between today and the 1970s. And this is a graph of real interest rates against the gold price. And the two gray lines are the 1970s, and the two green lines are the 2000s, really the 2000s until the present. So June 2004 to June 2023. And what I really want you to look at is what happened in those ovals at the end of each of those gold bull runs. And what I want you to look at on the gray lines to the left of the chart are, you can see there's a huge amount of volatility in real interest rates. What happens is right over to the left-hand side of the chart, we're in the early 1970s or the early 2000s, and we've got the US in particular running twin deficits, and the Federal Reserve is reacting to this by putting up interest rates. It's trying to get on top of a burgeoning inflation problem. What it does is it actually pops an internal credit bubble. The economy goes into a recession, if not threatens a depression, and the Federal Reserve brings interest rates down to near zero or zero. Real interest rates go negative, and that's the point you can see for both lines, both the green and the gray lines, around about 0.49. But 49 is 49 months, so we're basically looking at 4 years and 1 month after the start of this chart. So that's the bottom of the depression. It corresponds to sort of February 1975, or it corresponds to about July 2008, when the likes of Lehman Brothers were going down. And then what you see after that is the recovery. We try and get back to the erstwhile sort of status quo ante, positive real interest rates. So you can see the green line and the gray line, the dark green and dark gray, they come up to that 0 point. There's zero real interest rates, and then they trog along that for quite a while, actually, much longer in the case of the 2000s crisis, if I can put it that way, than in the 1970s. But then you get this attempt at normalization where real interest rates move positive, and you can see that on the far right of the graph, the green line. In the last few months, we've seen real interest rates go positive. We know that because federal funds rate 5.25%, and inflation, what now, 3.4 or something like that. So real interest rates. And I'm just contrasting then that green line with the gray line, and that's what that blue arrow is going across. I'm saying I want to compare that green line on the right to what happened in the equivalent period on the gray line when we came out in the 1970s. So I want to just look at exactly the same data in a different way. That is real interest rates on the x-axis, the gold price on the y-axis. Where are we now? This is in the current crisis, 2004 to 2024. Where are we? Well, we're at the point roughly marked by the arrow. Gold price a bit over 2,000, real interest rates about 2%. And, if you look at that graph, you think, well, there are not many ways that gold can stay at this level. You think it has to go down. But what I would say is, look what happened in the 1970s. And this is the equivalent graph. That is the last point that's arrowed there, where real interest rates were negative. The gold price was a bit over $300 an ounce. And you think, where does it go? Because you look at that graph, and again, you can't see any other way for that to go but the gold price moving downwards one way or another. And what actually happens, this is what happens. You see that this point here, that was the point that was arrowed in the last chart. And what actually happens is gold moves here as real interest rates go positive. First of all, the gold price goes up. And then when real interest rates go down, it goes way up. And actually, gold completely rebases. What's interesting about these two best fit lines, the orange dotted line and the blue dotted line, excuse me, is that they have almost exactly the same gradient. The only difference between them is how far apart they are, which is a sure sign that the gold price is rebasing from one, if you like, way of thinking in terms of its value to another one. And you can either argue that the orange line is about $400 an ounce above the blue line, or you can argue that it's about 4 times higher. And what does that mean for where we are in the current market? Well, those green points are the ones you saw before for the current crisis. The solid black line at the bottom is the best fit line. And then what I call the midline, which is the light green line, that is $400 an ounce above the above the black line. And then the solid gray line at the very top, that is 4.5 times higher than the solid black line. So when you see me, and you'll see me quoted sometimes as, where do I think the gold price could go? Well, if that comparison holds, then we could see where we are at the moment, roughly. We could see it go out here, and then as real interest rates fall, could it get to 4,500? Yes, I think it can get to 4,500. There are many other ways of looking at it, but that is my central scenario when you're looking at real interest rates, and why real interest rates are not necessarily bad for the gold price. It's only when real interest rates reach 4%, so that would be the equivalent of having the Fed funds rate at about 7.5% now, that will kill the gold market. And 7.5%, it'll kill a lot of other things as well at the same time, but that is what killed the gold price in the late 1970s. There are lots of other things that are pushing gold higher at the moment. This is total US monetary base, so M0. The gray line at the bottom is what the total monetary base would have done if it had just grown through the crisis at the trend rate. The light green line above that is what happened after the crisis, the global financial crisis, when we had QE1, QE2, QE3, and then you see the attempt at tapering at the end. And then you'll remember in 2019, in response to stresses in the repo market, the Federal Reserve quietly said, well, actually, we're not going to do that tapering. So, the dark green line is then what I thought would happen when they made that announcement. I thought the monetary base would go sideways for a while before growing again. Then we had COVID, and what you can see is this huge increase there. All right, it came off. It's come off in the last year. That is 2021 and 2022 are the last 2 points on that upper gray line. What's it doing now, however? This is the monthly chart, and you can see the same peak in December 2021. Then it comes off to December 22. And what's it doing? The total monetary base is rising again. Why is that important? Because there's a fantastic correlation between the total US monetary base, which I always like to look at as it's either dollars in circulation, or it's dollars in circulation and dollars that could be in circulation. And you would expect that to have a relationship with the gold price, given that gold is a real asset, and to all intents and purposes, the Federal Reserve can print as many dollars as it likes. So, back in the days of $35 an ounce, there was a mandated legal requirement to maintain the relationship between the two at 35 to 1. Now, I'm positing that there must be some sort of relationship, and actually the mathematics would suggest that the market would agree with that, and it thinks there is a relationship. You can see here, you can see that sort of what I'd call a false peak in 2012 with the gold price, and then it settled off into this sort of area, but still very strong in terms of the correlation. If you want to look at those two things, if you look at the green line there, that is the total US monetary base. If you look at the gray line, that is the gold price. And if you look at the light green line, that is what you would have predicted that the gold price should be based on its correlation with the total US monetary base as it would have been perceived in that year. And you can see not a perfect relationship, but not a bad relationship at all. if you divide one by the other, this then gives you a sort of a measure of how much speculative pressure is in the market. And you can see that peak in 1980, round about here. But you can see the 70s had two peaks. And one of the big questions is, well, what's happening here? Is that one peak? Is that two peak? And is that the trough? And if you look not at the total US monetary base, but if you look at currency in circulation, again, a very good correlation. You see it much more clearly. Two peaks in the 1970s, one peak in the 2000s. What does that mean in terms of where we go from here? Well, if you do the strict correlations and you say, right, where should the gold price be? You're going to come out with a figure of around about 2000. And that should then, and those are those three straight lines at the bottom on the far left. You're going to come out with a figure of about 2000. And could the gold price fall to those levels? Yes, it could. But if you impose that speculative pressure, where does it go to? It goes to 3,300. So where are we sitting? We're sitting at 2,300 at the moment. Could the price go down to 2,000, 2,100, 1,900? Yes, it could. But equally, could it go up to 3,300? So my point is, I think that there's an asymmetric risk there, if you like. There's $1,000 to the upside that the gold price could go, and there's $300-400 to the downside. So I definitely think that this is to answer Sarah's question, is it an investment for now? Yes, it is. You're riding the cycle, no doubt about that. But that's what I think we like to do in investing, isn't it? Is it a store of value? Yes, it is. It is that as well. Just to remind people, those of you not distinguished enough to remember, a lot of the similar sort of things were going on in the late 1970s, and not just economically, but also politically. Just to name a few, you had the Iran crisis, you had the invasion of Afghanistan by the Soviet Union, the Middle East was in crisis, Africa was in crisis, Chrysler had been bailed out by the US government for the umpteenth time. So the parallels, in my opinion, are absolutely striking, and that's where I think we are in terms of our economic evolution, and that's why I think that gold can go much higher. And finally, I'll leave you with the quote that I think summarizes it, attributed to Mark Twain. Never know, he may even have said it, but history doesn't repeat itself, but it often rhymes. And I definitely reckon that we're in one of those points in the cycle where it's rhyming, and it's rhyming pretty heavily. So with that, Sarah, shall I come off my screen share and send it back over to you?
Yes, please. Thank you very much indeed for that. Unfortunately, we have run out of time in this section of the webinar with you, but I do want you to hang around until the end, and I'm going to bring you back in to summarize and lob some questions at you. So thank you very much, Lord Ashbourne. Really appreciate it. So we are moving swiftly now to our first company. It is reopening a historically high-grade gold district in South Australia. It recently lifted its resource estimate for its Tunkillia project to 1.5 million ounces. Now, the company is Barton Gold. It's listed in Australia, Frankfurt, and the US. The board hold a fifth of the stock. There's a reason they're doing that. The founder, the chief executive and managing director is Alex Scanlon. Try not to be too formal there. Thank you, Alex.
Thank you, Sarah. It's a pleasure to join as always. I will bring up and share our current presentation, which I'm actually delivering tomorrow at the London 121 conference. So very, very fresh. For those of you not familiar with Barton Gold, we actually, and I have to give a tip of the hat to Charlie. His entree to what's happening in the gold market right now is very much the same basis on which we built our premise around large-scale gold investment in a tier 1 jurisdiction. Before we get into the presentation, this image here on the cover is actually an image of a high-grade open pit that we have, very shallow, very accessible, and something that will come into play for us in the near future. But from a very high level, who are we? What are we doing? Why are we doing it? We are a pure play gold developer in South Australia. So we set about acquiring a very substantial ground position in Australia in tier 1 geology, tier 1 jurisdiction in terms of law, and then also tier 1 workforce. And we really settled on South Australia because as a state, it's very interesting. Within Australia, obviously, Australia is very well known as a gold producing jurisdiction. South Australia actually contains about 25% of Australia's known gold resources, but speaks for only about 2.5% of annual production. And that's really a legacy of very heavy investment in an IOCG belt around Olympic Dam. So the world's probably now second biggest everything deposit. Everyone's very familiar with it. And for about 30 years, people have been investing very heavily in trying to find the next Olympic Dam. Well, BHP has now consolidated that belt, and that belt sits over a mineralized basin, which is basically fueled by granite intrusives. And on the east side of that basin, the mineralization is deep and coppery, and that's where you have Olympic Dam. But that same basin moves to the west and becomes shallow and gold, as a matter of speaking. And in that particular area, you have a 130-year-old high-grade producing gold district. We spotted this, we did a lot of due diligence, and we basically bought the district. So we bought every significant historical exploration and production asset. We bought the only gold mill in the region. And then we set about building a much larger platform for a much larger development. So our strategy there has been threefold. One, established a really large-scale baseload mineralization that we've done at our Tunkillia project. Two, shift to complementary high-grade drilling, targeting high-grade assets because we can blend that with our existing bulk open pit mineralization, but also use that to leverage our existing infrastructure. And this is how we get from being a so-called explorer developer into a producer with relatively low cost, relatively low risk, and sort of a stage progression. So I'll explain that in greater detail. But the short summary is we have been very successful in doing this. The past 12 months have been very exciting for us. We have done everything from selling golds to having 3 different resource upgrades. We've had a number of different institutions join our register, some as substantial shareholders. We have started scoping studies on that large-scale Tunkillia project. We have high-grade drilling, that is high-grade target drilling, which has started actually yesterday in that neighboring high-grade gold field. And we are very, very well capitalized to continue doing all of this and really drive some interesting innovation during 2024. So looking at our capital structure, we have a pretty simple, very clean capital structure, about 218 million shares on issue. In capital, sort of market capitalization terms, we're about 70 million Australian dollars, with an enterprise value in the sort of mid-50s once you factor our gold, our cash, and also our gold and concentrates. So we actually produce gold concentrates from existing stockpiles and materials, and selectively sell those because really limited the amount of capital that we raise publicly. That is what has helped keep us help us keep a very constrained capital register. And what we've seen over the past 18 months in particular, as we've converted our geological premise into new discoveries, new resources, is in sort of a steady progressive manner, is a very strong consolidation of the market, both in terms of the institutional participants and retail participants around our story, around strong management alignment, strong consistent performance. And therefore we've really dramatically outperformed both the gold price itself, as hopefully we should, being a leveraged and riskier version of investing in gold. But we've also dramatically outperformed even the major producers indices like the VanEck Producers Indexes. So it's been going very, very well for us. We're hitting sort of new all-time highs just as we're actually shifting into some perhaps much more exciting and valuable elements, being scoping studies or economic studies and our high-grade drilling. When we think about the capital structure of the company, we can't forget the human capital. That is the most important part. We have built a team that reflects our future ambitions. So we have, just in our leadership team, well over 200 years of experience exploring for permitting, financing, developing, operating, and optimizing mining assets with a very strong pedigree both in gold and in South Australia. And those of you who remember your gold M&A history may remember that while today Newmont is buying Newcrest, 22 years ago, Newmont bought Normandy Mining. And Normandy Mining was the Southern Hemisphere's largest gold producer, and one of the largest in the world at that time, producing about 2.5 million ounces per annum. So we have basically rebuilt some of that core team. We have a lot of Normandy and Newmont names in our team here, and we've got a lot of proper mill development and operating expertise as well. And as I mentioned, this is really shaped towards that aspiration. We don't have a board and a management team that just reflects a driller explorer. We are a developer. And so this big picture, to bring it together, that ambition is for us to take these assets and turn them into a 150,000 ounce per annum producer. Now, what are we focused on in doing that? So where we are really focused is our Tarcoola and our Tunkillia projects. And you sort of see these in the sort of bottom right of the map. These are two assets that together, and they really do operate together because they're 70 kilometers apart. So functionally, they're really one project in long-term development. But together, we have about 3,000 square kilometers of ground there. So this is a huge ground position. We have over 100 kilometers of major structures, and on less than 2% of those of that strike, we have now mapped out 1.5 million ounces of data. So we've really established this long-term base from just a very small part of that sandbar, so to speak. And what we're focused on is open pit mineralization. Open pit mining is faster, easier, cheaper, and safer to explore, for, develop, and operate. And our strategy is threefold. And we sort of work back to front in that strategy. We want to establish a long-term company-making project. So we're looking for large bulk open pit mineralization, something that can be very capital and operationally efficient. And then we want to supplement that with higher grade blending material. So we start with strategy number one. This is where we have built this Tunkillia project of ours up to 1.5 million ounces. That has now moved into the development stage of planning. That's now just started scoping studies. And we are now up and drilling in that Tarcoola gold field. So this was actually the hub of high grade gold in South Australia, which I'll explain a bit more in the coming slides. And the idea here, what's really interesting about this is, because these assets will eventually operate together, eventually high-grade material from Tarcoola will blend into bulk low-grade material from Tunkillia for a very, very compelling combined operation. But Tarcoola has also processed through our existing central Gawler mill. So that mill you see in the top left corner of this map has processed this material during 2017 and 2018. Very, very strong recoveries of about 93 to 94%. So we have proven logistics, proven metallurgy, and proven fully licensed infrastructure. So as we now drill up and sort of demonstrate or prove a series of high-grade resources at Tarcoola, we can actually utilize that to bring forward operations using the existing mill. And instead of trying to go from 0 to 150,000 ounces per annum by developing Tunkillia, we could start with Tarcoola, our existing infrastructure. And for the cost of a mill recommissioning, we can go from, say, 0 to 25,000 ounces to 50,000 ounces, and then use that to actually internally fund our expansion to 150,000 ounces. So Tunkillia becomes an expansion project, and Tarcoola is sort of a step ladder that takes us there in a much lower cost, much lower risk basis. Now, it's really important to understand why we are focused on bulk open pit mining. Why did we anchor around Tunkillia and the strategy and not just jump towards the more selective high grade? And the answer is that bulk open pit mining is better and cheaper than anything everywhere all the time. Volumetric capital and operating efficiencies are the key to low unit costs and therefore high profits. And we profile Capricorn Metals here as another Australian listed company as a perfect example of this. This is the team that's literally made a career doing this systematically across very well-known bulk open pit, sort of 1 gram ore bodies. And they acquired their Karlawinda project back in 2015 as a 650,000 ounce asset. They grew that to 900,000 ounces, and then 1.1 and 1.3 and 1.5 million ounces. And then they really focused on scoping that as a bulk open pit, sort of volumetrically efficient operation. They have since grown that to about 2.2 million ounces, but importantly at a resource grade of 0.7 gram per ton. So something that we might traditionally think of as low grade, or particularly in a commonly underground high grade setting. However, they now run that as about 4 to 4.5 million ton per annum operation. They are producing 120,000 ounces per annum with a head grade of 0.8 to 0.9 gram per ton. And they are regularly one of the lowest cost gold producers in Australia. So producing for between $1,300 and $1,500 Australian, or about $850 to $1,000 US. So really instructive. And we saw in our Tunkillia project some indications in the data of similarities to Carlo. So our timeline is below the Capricorn timeline here. We acquired our project about 4.5 or 5 years later as a 550,000 ounce asset. We grew it to 900,000 ounces. We found 5 new gold zones, and then we systematically grew it to 1.1 and 1.3 and 1.5 million ounces. So following almost a stunningly identical progression there, and now are moving it into the same large scale development study. So we're following the leader, so to speak, in this, and we're doing it quite well. And we think the way that this is looking is going to be very interesting. So this is the Tunkillia project. When we originally acquired it, we acquired essentially this sort of dark blue central mass of the main deposits area there. And we first validated our theory that there was a higher grade central zone in the middle. And then we extended that to depth twice. And then we found 5 new gold zones and have since converted 4 of those into new resources. So that now takes us to 1.5 million ounces there along the western margin of the shear zone. We have done that quickly, we have done it reliably, and we have done it cheaply. So our cost per ounce of discovery or resource growth has been about $15 Australian on an all-in basis. So a true all-in cost, drilling and assay and consultants and logistics and labor and everything. Very, very, very efficient cost of growth. But this is really for us just a longer term starting point. We have another 20 kilometers of untested shear here. This is now moving with development studies. And what we're looking at there is a really attractive development geometry. So this is where I get quite excited as a financier and an economist and a numbers guy. The majority of our ounces sit within 200 meters of surface there. And we also have this central high grade core. So you have to start a big bulk open pit somewhere. The cross section on the right hand side of the screen here shows you what we're looking at in that central high grade core. And what that is, in some words, is about 100 meters of mining grid. So this is a football field long and wide in terms of mineralization. And about 20 to 30 meters of that has a higher grade core with some mineralization grades between 2 and 10 grams per ton. So really ideal central higher grade pit. And then as we open that to the north and the south, this light blue sequence that you see, which looks like a T-zone in this cross section, is shallower, softer, oxide and transitional mineralization. There's about 250,000 ounces that will pay us to do the pre-strip as opposed to us paying to do the pre-strip. So that adds, that makes for some very attractive figures. And then everything that we're looking at with Tunkillia is just in that green box. We think the potential here for this to be a much larger district is considerable. And if you had a district of bulk open pits operating, you would love to have high grade gold nearby. That is where we then look 70 kilometers north, back to Tartula. Again, this is the home of South Australia's entire gold history, in particular its high grade gold history. In the southwest corner of our tenements, there is the historical Tartula gold field. The gold was discovered in 1893. People were mining gold from shallow structures there at 30, 40, and 50 grams per ton during the early 1900s. And then 100 years later, somebody put a shallow open pit around one of those shafts and produced another sort of 30,000 ounces at 3 or 4 or 5 grams per ton bulk grade to our mill. So we have stepped back and said, what is the series of events or occurrences? What's the system that fed these sort of 600 historical high-grade workings? The pit itself that you saw on the cover is very interesting. This is complex geology. We have found a whole bunch of high-grade drilling intercepts around it, but we've actually just drilled the pit floor because we have a walk-up and restart open pit. Even if we just put 20,000 ounces in that pit, that is essentially year one of our stage one strategy. But where it gets really interesting is we say, consider the incredible value that came out of this tiny little pit and step back. In parallel with growing Tunkillia to 1.5 million ounces, we've spent the last 2 to 3 years in building a new regional structural model. We published this in November last year. This is the first time in 130 years of high-grade production that we can actually see all of the subsurface structures. And it's the first time that all of this historical high-grade production fits in a consistent structural framework. Yesterday, we started drilling about 7 different targets across this for repeats of that high-grade mineralization. So very exciting times for us. The past 12 months have been very exciting. We have sold gold. We've had 3 resource upgrades. We've had 2 different rounds of institutional investors buying into our story. And looking forward, we think 2024 is going to be a very exciting year. We will be putting out scoping study results soon. We will have nonstop high-grade target drilling. We will be selling more gold, and we'll probably have a few more resource upgrades. So we, in and amongst the market, are a pretty unusual proposition. So we have a very strong platform. We are growing it quickly. We have a very clear pathway to development. And really this combination of strong platform and reliable, steady performance is really what we would propose represents true value to investors. And in fact, you know, our investors who are with us now, we're typically the #1 performing junior mining company in their portfolio by a considerable margin. So we will endeavor to do the same going forward, and certainly very happy to answer any questions that you may have.
Many thanks, Alex. So you just said there, non-stop drilling for high-grade targets. Do you have the utilities to support that statement? Non-stop drilling?
Correct. Yes. So we basically are not limited by terrain. We're not limited by infrastructure. We're not limited by capital. We're not limited by drilling availability. One of the great things about where we are is we are in wide open flat terrain. So we aren't drilling in deep mountain ranges where you have the helicopter rigs in. We have, you know, year-round drilling. We have about $13 million worth of cash and gold, and we have regularly 5 to 10 drilling companies that are always bidding to do our work. So for us, it's really been a case of building up this target set as quickly as possible. And now we're going to be going out and testing them as quickly as we possibly can, trying to, you know, convert those of the highest promise into new gold zones, and then aggressively following that up to convert those into resources, create that base load, and basically justify pushing the green button to restart our mill and shift into production.
So you spent a lot of time explaining to us why open pit, why you have a laser-like focus on the open pit operations. Now, Lord Ashbourne was talking about the potential for price movements within gold. So I'm just wondering, when the price of gold alters, does that change the baseline economics of the projects significantly?
It does. I mean, obviously, the gold price is your primary leverage to unit economics or unit profitability is the gold price. This field that we're looking at now, because of the nature of its geology, we believe it will create a field of high-grade open pits that would likely in the future become a series of underground mines as well. So you always would, you know, obviously do your economic analysis to determine which, if any of these, would you want to go underground, on what productive scale, and why. But obviously, as the gold price goes up, that proposition becomes more attractive. The thing that is difficult with underground mining is that you are very constrained, right? So you have a development like, I'll explain this in the context of a somewhat, you know, silly saying, but there's this saying about sucking golf balls through a garden hose, right? You can only move so much through an existing port. And so you don't have the ability to respond to input cost pressures in an underground mining environment the way that you do in an open pit environment. In an open pit environment, you can adjust your equipment sizing. You can move more and less material, and you can kind of see everything all at once while you're mining. In an underground environment, your relationship with the mineralization is often just the walls right in front of you, and you have no choice but to slug it out with the economies of 1 cubic meter at a time. And if your costs double or triple in developing that meter, life can get very difficult when it actually comes down to the profits. So it is more favorable to at least start and control your baseload production with open pit.
Many thanks. Alex, we're just losing your sound now, so this is probably a good time to say thank you very much indeed. We really appreciate it. Lovely to get an update on Barton Gold, and I hope the next 12 months are as successful as the previous 12 months. So
Thank you very much.
yes, you're welcome. Yeah, mineral resources upgraded 3 times during the past 12 months. That is quite significant indeed. Alex is currently at a mining conference in the UK, and he said that the energy is very different to what he experienced 12 months ago. So to me, that is a positive. Okay, to our second company, ASX listed Dart Mining. Now it's got one of the largest tenement footprints in Victoria. Its exploration portfolio focuses on orogenic gold, porphyry, precious and base metals, strategic minerals, including lithium. Now, in fact, Dart was the first exploration company to discover lithium on the east coast of Australia in 2016. James Chirnside is the managing director and chairman. James, it would be good to see you. If you can put your camera on and we can hear you as well. Thank you very much indeed. I'm handing over to you.
Thanks very much, Sarah, and good morning or good afternoon, everybody. Great to be here. It is, as Lord Ashbourne said, as the previous speaker said, very exciting times in mining. The last couple of years have been very difficult, I think, with cost pressures. I think investors have had a fairly hard time. But now we've got the commodities themselves coming to life. I think it puts a bit of a different spin on it, and investors are starting to take notice. I think Alex was just saying that he got a different buzz from the mining conference that he's attending in London, and actually I was there earlier in the year, and I noticed the same thing. It was just beginning to stir. So I think that's where we are. But let me get on to our presentation, and I'll be fairly quick through the first part of it, and then we can spend a little bit of time on each of our projects. Tim, are you sharing the screen from your end? Thanks very much. That's great. Okay, so we left it to Tim to operate the clicker, if you like, because we may have internet issues at this end. Tim, if you could flick forward, please. Forward-looking statements. There's a profile on the company. We have 3 directors. We're ASX listed. Our stock code is DTM. We've got 258 million shares on issue. We are a paltry $8 million market capitalisation. We have actually had a pretty good run this year. I think our share price has doubled since March, and that's as a result of people returning to the market, looking for companies with valuation and leverage to the exploration game. Next one, please, Tim. Okay, so my observations, and these are only my own, but I have spent many years in equity markets, in metal markets as well, trading as a fund manager as well. And I follow the markets very closely, just like I'm sure everyone here today does. The precious metal complex has performed very strongly over particularly the last 5 years. Silver and base metals have caught up. I think silver's lagged gold's lead a bit, but that is beginning to look more interesting. Copper and some of these energy transition metals have performed pretty well, and I note that copper is now trading through 5 US cents a pound, or $10,000 US a ton, as of yesterday. So that's a good move. I note that Goldman Sachs also have longer-term predictions of a much higher price for copper. Copper is potentially suffering from the perfect storm in a way, where we're starting to see greater demand for the metal through electrification, energy transition, and we're also starting to see some fairly severe constraints on the supply side. So copper's a good metal. There was a bit of a false run on copper a couple of years ago, and it didn't work out terribly well. It didn't go terribly far, and no one made any money out of it. But it does appear now to be moving finally. So the things that are driving the gold market, particularly, I'm sure most of you would be aware, are the central banks. I was curious to note that Walmart and Costco are both selling gold over the counter, and it's hard to know exactly how much, but I've seen speculation of up to $200 or $300 million a month is being sold in the US through Costco and Walmart. So I think that's interesting. There's obviously a great deal of revived or renewed interest by retail buyers, but also in China, where you can buy very small denominations of bullion, and the demand from there has been very strong. So to me, really, it remains a central bank game. I mean, they're the ones that do the volume. The Chinese central bank has a publicly stated objective of owning as much gold as the United States, and I think last look was that the Chinese central bank, or People's Bank of China, had something like 2,500 tons of gold, versus what is reported in the US at about 8,500 tons. So there's a lot of tons to buy there for the People's Bank of China if they want to match the US. Technically, as Lord Ashbourne very cleverly spoke to earlier on, technically and fundamentally, the precious metal complex, including gold and silver particularly, but not restricted to those either, is very constructive and remains so for the foreseeable future. The interesting thing, and I was at a conference last week in Sydney, and the topic of conversation was all around the lag effect on equities versus the metal prices, and that's very real. So gold equities, if you're a producer, you've had a pretty good 6 months or 12 months. If you are a developer, as we saw with Barton just before, who are right in that space, that they've had a very good run, but others in the developer space have not had such a strong price performance. And then you trail off into my part of the world, which is in exploration, where the return on the exploration sector up to the end of 2023 for 2 years was minus 80%. So a lot of investors have lost a lot of money over the last couple of years in the exploration space, particularly. And a lot of that actually came as a result of the lithium crash last year. There was some it was a very overcrowded trade, I suppose you could say, both in the physical, in China, where it was being held in warehouses and financed, very heavily, very levered positions on the physical, but also in the equities themselves. So equity prices really have, got a thrashing last year. There are signs of life in lithium now. It has recovered off its lows. I think 5.5% lithium concentrate got down to a low of about $850 a ton. That's off a high in November 2022 of around $8,500 per ton. So enormous decline in the price of lithium last year, particularly. So the sector's a bit on the nose, certainly at the exploration end. The sector's been on the nose for quite a long time. In fact, a very long time, last couple of years. But we are really starting to see genuine investor interest in it. And as is typical in these sort of these moves, the money, institutional money, starts with producers and safe bets and Newmont and companies like that, and then it slowly dribbles down into the smaller cap market companies, and then into the developers, and then ultimately into the exploration space. And I think the second half of this year is going to be really interesting from that perspective. So we'll see how it goes. Tim, could you flick the slide for me? Thank you. I'll just walk you through very quickly our corporate objectives and our profile. We are always looking for new and interesting bits of ground to go and explore. There's a lot of people who are prepared to talk at the moment because a lot of smaller companies have had trouble raising money. They're really strapped. And so we are actively having those kind of conversations with people. And I'd sincerely hope that sooner rather than later, we're able to land something that might make a really big difference to us. We have got enormous amounts of our own prospectivity, and I'll get to that in a moment. But the ways of doing at a corporate level, you can attract inbound farming joint venture type relationships. You can also go on the hunt, and we have our own drill rigs, so we're able to actually drill for equity into other people's projects when they don't have the cash to do it themselves. And our costs of drilling are very, very low compared to the market, less than 1/3 of what you might pay a contractor for drilling. So we've got our own drill crews and rigs, and that allows us to drill for equity at a low cost to us in cash, but charged to the joint venture partner at prevailing market rates. So that's quite a good little model. I'll talk a little bit more about inbound farming joint ventures. We have a joint venture agreement with SQM. SQM are one of the largest lithium companies in the world. As Sarah mentioned in the introduction, TallyMoney we were the first people to discover lithium on the east coast of Australia. We actually had originally initial discussions with SQM back in 2018. But then the market for lithium crashed after that, and then it recovered, and I think most of us know the history. But we have a very good, healthy relationship with them. They are funding all of our exploration costs in relation to our Dorchap lithium project, which I'll get to fairly soon in the presentation. So our operational profile, moving away from the corporate, is that we're very self-reliant. We do all of our own geological assessment and modelling. As I mentioned, we run a couple of drill rigs with drill crews. We have field crews that we send in to do geochemical sampling and rock chip sampling and things like that into the field. That model or that setup works extremely well for us. I think we also have our own transportable camps and all that sort of thing, which enables us to really cut the cost of exploration. I would say that TallyMoney is probably one of the lowest cost explorers in the country. We don't pay accommodation because we're transportable camps. Other advantages that may not come off the top of your head with a transportable camp is that you can put it on site, so you don't lose time every day commuting to the nearest hotel, which could be an hour away, or 2 hours per person with 10 guys in the field. Suddenly the hours log up and the work's not getting done. Tim, if we could move to the next slide. So we've got a very large footprint. Most of it, in fact, 99.9% of it, is in Victoria. A lot of that footprint is up in the northeast of the state of Victoria, which is the high country. Hence the orogenic gold prospectivity that we have, or geology that we have. So the footprint actually includes about 80 different geological targets and projects across what we define as 6 different work areas. Within the footprint, we have 9 historic gold fields, and we are furiously drilling one of those gold fields at the moment. That project is called Rushworth, and I will get to that. The other thing that sits within our footprint are a number of porphyry targets. Porphyries are, for those that don't know, very enormous tonnage, typically fairly low grade, with pretty much any kind of metallic dominance. And in our case, it is molybdenum, but mixed with that molybdenum, we have copper and zinc and silver as well. That's Mount Unicorn, which is a bit of a flagship project. It's in resource, 209 million tonnes of fairly low-grade molybdenum. From my perspective, it remains a exploration target. We need to drill it more, but exploration around porphyry targets is incredibly expensive. Deep holes, lots of them, can get expensive. So that is a good example of a project, for example, that we would be looking to farm out, to do a deal with someone with deep pockets who wants to come in and gradually earn in to the economics of that project. So the diverse geological setting, as I mentioned, orogenic gold, porphyry, and we also have, it's a historic tin mining area, with lithium, cesium, tantalum, pegmatites. So they're all fertile. All the pegmatites that we've come across are fertile with lithium, and we've had some very high hits on cesium, funnily enough, and there's lots of tantalum there as well. But the project, and we drilled 3,000 meters on Dorchap last year. It's currently subject to approvals on some permitting where we need to put some tracks in, and we've got a planned 3,000 meter diamond program, which we're hoping to get to in the second half of this year, subject to the permits being or the applications being approved. Next one, if we could, please, Tim. The last point on that last slide, and there's no need to go back to that, but we sit within the quite famous, certainly in geological circles, Lachlan Fold Belt, which is an enormous geological structure down the east coast of Australia, which has led to some of the most prolific and productive mines in the country's history, including one up at a place called Orange, Cadia is the name of the mine, where they're producing around 1.2 million ounces of gold per annum. It was owned by Newcrest, which, as everyone would know, have been taken over by Newmont. So they're mining gold up there at less than a gram a tonne, but because there are so many tonnes and they do everything on site, including pouring the actual gold, it is a very profitable mine. But that's a great example of one of the big mines on the Lachlan Fold Belt geological structure, which runs from basically Cobar up in New South Wales all the way down into Victoria through where we are, and then out to the west towards South Australia. It doesn't make it to South Australia, but it out that way. So our work schedule, and I spoke at the Master Investor Conference this year back in March, and I have since updated this work schedule. We've got drill ready 3,000 meters of diamond drilling planned for the Dorchap lithium project. The permitting applications have been lodged subject to approval. When we get the approval on those, and subject to a further improvement in sentiment and price in lithium, which is, I think, very likely in the second half of this year, we will go out and begin drilling on that. Rushworth is the other priority project that we're working on right now, and we're literally drilling there pretty much continuously. I think we've just finished around 1,000 meters on our phase, what we call phase 1, which is testing the structural aspects of a prospect within the Rushworth gold project. Rushworth is a gold field from historic times. It was mined from about 1860 through to 1910, I think. There was over 100,000 ounces of gold taken out of that gold field at the time. We have about 861 square kilometres of ground, which includes the entire gold field, and we're just north of our neighbours, who are Southern Cross Gold, who have had a tremendous success on their Sunday Creek project. They're literally just south. And actually to our southwest, about 40 kilometres, 30 odd miles, is the famous Fosterville mine, which is one of the highest grade producing mines in the world. Significant production, I think up to 300,000-400,000 ounces a year. and they're yielding on that mine. It's underground. The deeper they go, the higher the grade gets. And that's, I think they're producing at an incredibly low all-in sustaining cost. But they have actually run out of reserves. They've had something like 24 rigs operating there for the last 2 years, trying to prove up more resources. Haven't been able to extend it at this stage, but there still is potential for them to do so. Anyway, we're
James,
45
James,
kilometres. Yep,
James,
are we
sorry,
done?
you're overrunning. So if you want to just wrap up, if you want to
Yeah,
summarize.
well, okay, well, that's the Rushworth and Dorchap projects. We're working on those. They're our focus. Just go to the next slide, Tim, can you? Which is some images, and that brings us pretty much to the end. So we drill at 1,200 metres in the snow. We drill in 45-degree heat out on the plains. We're sufficient with camps, provide all our own discounted fuel, water, you name it. And that's Start Mining, and thank you very much for having me and listening.
And you've got your own drill rig as well. Very, very important in this climate, James. Very, very quickly, you've been prospecting for 21 years, starting in 2003. What's been the most exciting discovery, or has it yet to be made?
Look, I think you can't deny the Mount Unicorn molybdenum project. It's the 6th largest molybdenum deposit in the world today. It is low grade, but it's porphyry, so bulk tonnage, 209 million tonnes. And I think the other exciting discovery, and it was straight out of left field for us, was the lithium back in 2016. It's the only lithium project on the East Coast. Everything else and Australia produces 50% of the world's hard rock lithium. So most of them are coming out of Western Australia. We have the only one on the East Coast. So between those two and the 9 historic gold fields, we love gold at the moment. We've got a very, very busy and very prosperous next few years, we think.
Many thanks. Many thanks. James Churnside, Managing Director and Chairman of Dart Mining. Thank you very much indeed. So James talked about it being left field. I think it was an element of serendipity. So I wonder if serendipity played in the part of our next speaker. Now, our next speaker was so concerned about the traditional banking system that he designed a brand new monetary system to protect and benefit the customer, not the bank. He created Tally, the world's first mainstream alternative currency, a digital currency representing physical gold. That speaker is Cameron Parry, the founder and chief executive of TallyMoney. And I'll just look at all that work. Look how hard he's been working. Look at all those files. That'll tell you, the amount of work that goes on to create an alternative currency. And that looks pretty good to me. So I'll leave it to you now, Cameron.
All right, thanks, Sarah. I'll stop messing around with the sizing of that. Hello, everybody. I'm Cameron Parry, founder and CEO of TallyMoney. So I'm looking at, whilst you're looking at investments and different things you can do and with different factors, what I'm really focused on and what we've created with TallyMoney is looking at looking at the mainstream money and the choices we have in that. We all need money for everyday purchases. We all have savings before we decide to make an investment or as we're saving up for things that don't relate to investments. So I just want to go through, what we've been looking at while we do it. The first reason is that we believe people should be able to access money that holds its value and remains in their control. This seems a perfectly reasonable thing to do. The earner of the money should be in control of their money rather than the financial institution that they leave it with. And this is really, sound money and money that you can rely on and that stays yours is fundamental to individual financial well-being and promotes savings and productivity in society. And we know we should have savings, that we shouldn't just live on credit and that we need to save up for things over time, such as holidays and education and whatever. So what we built was an asset-based monetary system and payments technology that protects people from and works seamlessly with the fiat currency fractional reserve banking system. So this is not a crypto. So just to start here, or take a step backwards, we look at what is money. And there's three key elements. There are some other characteristics about fungibility and, you know, not having a perishable item, things like this, but there are three key elements to money. And that is that it's a store of value, a medium of exchange, and a unit of account. So as far as currencies go, you know, at the moment, you've got fiat currency like pounds or USD or Australian dollars for some of those mining companies there being in Australia. Fiat currency is a fantastic medium of exchange. It's a great unit of account. We all operate on it, but it's a terrible store of value. Gold, on the other hand, is a fantastic store of value, but it's not a good medium of exchange and it's not a good unit of account. And so then we're left with something like Bitcoin, you know, professing to be a currency. And I'm a big believer in Bitcoin and what it's achieved and what it can still achieve as a speculative investment that may become settled down as a more mainstream investment. But for now and for a long time to come, in my view, it's not a good store of value just because it's too volatile for that. It's not a good medium of exchange yet, and it's not a good unit of account. So that kind of fails on all three currently at the moment. For all crypto enthusiasts out there, I'm a big believer in Bitcoin. A lot of what I designed with Tally took a lot of the virtues of Bitcoin. So I'm a big fan. I just don't think it's not a mainstream alternative currency. If we have a look at fiat currency, which is the euro, the US dollar, the pound, the Indian rupee there, and the Indonesian rupiah, it's not a pretty sight. And the horizontal bar there at 100% is just gold. Gold's really boring. It doesn't do anything particularly interesting, but it's valuable. People know it's valuable, and it's actually a really good bar to measure everything else against. So, you know, probably fiat currency people would like you to measure fiat currencies against the US dollar, but the US dollar has the same structural problems, being a debt-based currency. The money supply can be, you know, decided arbitrarily to be inflated, to be expanded, and you know, it doesn't have this level of accountability. Something like gold, it's a physical asset. It is what it is. It's not everyone's cup of tea, but there's nowhere in the world really that it's not understood as a valuable, sensible, stable, trusted asset. So it's a good litmus test. It's a good bar to measure these other currencies against. So I'm more interested in pounds at the moment because Tally is only available to UK residents in the UK, and we're all living our lives in pounds over here, in our everyday lives as well as for our savings. And as I say, savings and money is different to, you know, what you'd be looking at with your investment hat. With your investment hat on, you want to have a look at maybe what's going to get you the best return over the next, whatever your timescale is. Does it need to have a yield? Does it need liquidity? All these things. But with money, and money, one form of money being pounds, we put up with a hell of a lot as the consumer, as the public, for the convenience of payments. And so I just want to have a look at this. When you measure it in something like gold, you know, what do we sort of see? And so gold priced in GBP, and this is how, I suppose, from an investment side, you might look at it. In the last 12 months, it's up 16.5%. If you held your money just in gold for the last 2 years, it'd be up 27%. If you held it over the last 5 years, which are, you know, if you're getting to the later stages of your career, you're holding on to cash and cash equivalents for long periods of time, you know, it's up 87%, which is obviously very dramatic. That's in 5 years. I mean, that's up to 5 years. After 5 years, you start losing my attention a bit, but I'll just go to 10 years after saying that and show that you'd be 115% up. And that's just being in a 2-horse race. You've got pounds in one account, and if you had access to gold in an account that you could use as money, that's what you'd be looking at. So I do like to compare Tally to pounds, and, you know, you are in a 2-horse race, and one of them's a crippled nag. Tally doesn't actually have to do anything particularly exciting to win this race. So what's really going on here, though, and this is where I'd like to for you to consider the problem with money that is our mainstream currency at the moment. what's really happening, because again, gold's not doing anything fantastical. It has a gentle inflationary supply, but it really is, maintaining its value, holding its value over time. So what's really going on? Your pounds in your savings account have gone down against gold by 14% over the last 12 months. Your bank may be offering you something 1 or 2% if it's easy access, or they might put you in a term deposit of 5%. Inflation in the UK at the moment is 4.7%. You might be getting, let's say you got that as an interest rate and you feel like you're keeping your head above water, you'll actually pay tax at the marginal tax rate on the interest that you receive from your bank. So, you really are on a bit of a hide into nothing. But the real cost, the real value of money and the value, I suppose the value of things, the cost of things, generally doubles every 10 years over time. So there's a rule of 72 in financial planning, and that means that the cost of everything is going up at 7.2% a year on average, not at maybe the lower figure that you might see as an official interest rate. Over the last 2 years, if you'd held your money in Tally rather than your savings account with your bank, the difference is 21%, less whatever interest you're getting from your bank. Over the last 5 years, your pounds in your savings account have been devalued at a rate of around, over the 5 years, almost to 47%. So you've lost almost half the value of that money if you had locked it in for the last 5 years. And obviously you might go in and out of pounds, but your trajectory, you're always on a bit of a loser. It fluctuates, there's no doubt about that, but you're just on a bad, probably the horse analogy is good. You're just riding a crippled nag. And over 10 years, I mean, you would have lost 60% of your purchasing power. Again, I'm just measuring this in something, I would say, honest, such as gold, and that we can all accept has a fairly stable, reliable value, and that we all understand it. So we did some gold price sort of price point analysis to have a look at over the last 24 years, if you'd put money for a period of time in gold, and if you held it monthly, versus yearly, if you held it for 1 year, 5 years, 10 years, because when you have a fluctuating price, you can either use the principle of dollar cost averaging and continue to build up savings, which is how people save money. So that's a reasonable thing. Or if you were just trying to lump it all into, for example, a Tally account and watch how it went, the crux of all this is that the average that gold goes up against the pound on average annually is 10 to 11%. But as you guys would all probably be aware, there is some volatility in the short term. And in fact, if you definitely don't want to have a loss at any period where you put money in over the last, since 2000 for a 10-year period, you would, you wouldn't have lost anything. You would have had a maximum gain of about 20% each year. On average, you would have made 10% a year. But then the 5-year one, if you sort of have a look at that, you've got a 14% chance of actually, I might have lost some money, in pounds over that time. But, to turn that on its head, that is to say, if you hold money, your savings in pounds, you've got an 85, 86% chance of being worse off. So I will take those odds. I would rather have a very strong chance of coming out on top. And I don't want what it means to come out positively. I don't want it to be capped. I don't want it to be capped by a fixed interest rate that the bank may tell me I get, regardless of what happens over the course of 1 or 2 or 5 years. So to summarize, the problem that Tally's addressing is that all fiat currency is debt-based. It's devalued by design. Central banks have inflation targets. If they could hit 2%, they're still devaluing your after-tax money at 2% a year. That's just another tax. So the banking system is actually a lending system, and it's designed to protect and benefit the bank to the detriment of the customer. Deposits are put at risk. As I say, savings are devalued. We, as depositors, we are exposed to the risk of debt default contagion in the system and bailouts. And then, of course, since the global financial crisis in 2008, 2009, governments all around the world legislated for bail-ins. And that means as a depositor holding funds with my bank, if they get themselves in trouble, they can actually expropriate some of my deposit, put it onto their side of the balance sheet, and issue me equity in the bank for my troubles. And I won't have a choice about it. Now, as all of everybody watching, if somebody offers you shares in a company that's going bankrupt, it's not a very good investment. So it's not something you would actually choose to do, but you won't have a choice. As we said before, gold is a great store of value, but it's a poor medium of exchange and unit of account. And cryptocurrencies, Bitcoin being the most known, they're not easily understood, and not easily understood how they derive their value. And they're not trusted, and you know, most of them are you know, very dodgy. Bitcoin, I don't believe is, but most of them are, and so they're not reliable. You know, global banking, cross-border payments, that's also decades-old technology. It's time-consuming and costly. So we looked to address all this with Tally, and the solution we came up with was the best of both worlds. You can have a trusted store of value that is gold, and with a real-time medium of exchange and monetary unit of account that's understandable, so you can use it as money. It's a full reserve monetary system that is that every unit of Tally represents a milligram of gold that you hold that we vault on your behalf with Brinks in Switzerland. And that's your gold. There's no counterparty risk or exposure to our company. That's just your asset. But through our technology, with a smartphone banking app, a smartphone payment account with sort code and account number, and a debit card, you get to use the value of your asset as money wherever and whenever you like. Customers use milligrams of gold, you know, for saving, spending, and just everyday use. As I say, it's really easy to understand how Tally derives its value. Every Tally you see represents your ownership of 1 milligram gold, and customers already know how to use it. You already know how to use the sort code and account number. You already know how to use to do electronic funds transfers and to use a debit card. There's some protections and regulations around what we do, which we have a security trustee arrangement in case anything, you know, if we ever cease trading, to make sure our customers' gold is protected in that event, which is highly unlikely, but if it ever happened, we would sell, your gold would be sold and the proceeds would be returned. That's a 1% fee to your non-Tally account. We operate the connection between Tally and the fiat world under an e-money institution that is not us, but under that umbrella. And wherever we go, we get jurisdictional legal opinion, and you know, we look at regulatory aspects of banking around anti-money laundering and fraud monitoring. All these best practices we apply at Tally. So primarily the savings market is what we're competing with here. And I say we're only in the UK at the moment. But if you're generating 10.5% on average from holding gold as money, we have a cost of coming in, a one-off cost on the deposit of 1.49%. After that, your only charge is an account keeping fee. And there's plenty of wiggle room, as you can see there, a net return of 8.5% in the first year. Obviously, if you held it over multiple years, then you're amortizing that 1.49%. So your net returns, you know, 9% and above for those other years on average. And that compares to what your bank's giving you. There are, as I say, it's your asset. You can do what you like with it. So there's no penalty for early withdrawals. You have instant access. If you do want a decent interest rate from your bank, you lose those things. You have those restrictions on your use of your own money. And then also, as I say, there's mechanisms in place that if we fail as a business, then, you know, you get your money back very promptly. And it's not being inflated away through the Financial Services Compensation Scheme or anything like that. Again, there's just no debt in the system. So it's nice and it's nice and simple and straightforward. You know what you're getting, you know what you're doing, and that's part of the appeal of Tally. Because you're also getting your capital gain as you realise as you spend your money. You do have a higher tax-free threshold with capital gain as opposed to interest you get with a bank, and the tax rate applied is half what your marginal rate would be. So it's sort of win-win-win on the upside, on the security and the protecting from the downside, and also on the tax side. And this is available now to use as money. So that's our primary thing with TallyMoney. There is the secondary market of how do I have an easy, convenient way of owning gold? If you have a look at Tally there, you lose 1.49% on the way in, which is a fixed rate FX and a gold handling fee that adds up to 1.49%. And then you have that monthly account keeping fee for storage and insurance and your transactional, being able to operate transactions and that. You've got the Royal Mint. You could go to Revolut. Revolut is 3 to 4% as a commission. The FX spread is not transparent. It can be up to 3%. You've got the minted there, where you'll lose about 5 to 8% on the exchange through the journey of coming into gold and going out. And as I say, Tally is very simple. If you want pounds, you're not going to get it in our account. Just send it back to your pounds account. It's pretty straightforward. In your bank account at the moment, your everyday account, you've got one currency and you get on with life. With Tally, we give you a better single currency and get on with life. And that's kind of what we're about. So the moonshot for us, just to wrap up, I suppose, was that, we think people should have access to money that holds its value, remains in their legal control. The monetary value should be universally understood and accepted. It needs to be accountable to something real. And frankly, if the government-run system is failing the public, it's up to the private sector to deliver solutions for the public, for the people. We're a first mover on a number of fronts with this. We're on social media. We've been in the press. And that's it. That's the end of my presentation. That's protect your money, grow your money. That's what you get when you open an account with TallyMoney. We have a waiting list for customers at the moment, which you're welcome to join. We should, if you make yourself known as a master coming through Master Investor, we will give you a promo code so that you're not paying the full £29 to open an account, which we do to filter out people who are going to get a benefit of this account and understand it. But your money's protected, it's yours, saving it, it beats whatever the bank's offering you, and you're in control.
Many thanks. And how quickly are you going to be able to eradicate that waiting list? Because I can see from the questions that you've got potential customers waiting to get involved.
We will start, I'm just trying to think, it'll be this month. It will be like 2 weeks.
Because
it'll be the week after next that we're looking to anybody on our waiting list. We have a few people already on a waiting list that we'll do another round of letting them in and hopefully having a better, more secure financial life.
That's wonderful, because Anthony says, is TallyMoney only for personal users or also open to business users?
At the moment, it's just retail customers, individuals. We do have an SME account on our product roadmap that we've been working on, and it's still probably 3 months away, something like this. So not too far. It'll definitely be this year.
And in terms of your scaling up ambitions at the moment, it's UK only. Where else would you like TallyMoney to be available?
Look, fiat currency, I say this to people, Tally gives you an everyday account where it's the most easy to understand how your money derives its value. If you ask someone, how does your pounds in your account derive its value and what actually is it and all this, a lot of people wouldn't really know and frankly can't be bothered thinking about it. They just want money they can rely on and that somebody's not whittling away the financial reward of their efforts as they move forward in life. So everywhere in the world, fiat currency is used. We really... we all walk around with a supercomputer in our hand. We have private property ownership rights, and with Tally's technology, you can own it, you can use it. When you're moving money Tally to Tally with another Tally account holder, I could be sitting next to you, I could be on the other side of the world. It happens instantly for free. You do want that touch point with the fiat currency on ramp and off ramp. But anyway, in short, so everywhere really is fine for Tally. We will go in. It's a global proposition. We wanted to get all of our testing and building and house in order and structure and even our team structure and all this type of thing proven and tested in the UK market because it's our backyard. But there are easier markets, frankly, for us to go for where the local currency suffers from hyperinflation. They don't really have great trust in government. So that would be a developing country would be our next jurisdiction, just to demonstrate its appeal in a different type of economy.
Thank you very much indeed. Cameron, I can see that lots of people are going into the webinar chat. If you go into the webinar chat, you will see the link to TallyMoney, courtesy of Master Investor. Cameron, thank you very much indeed. Really appreciate your time. Busy time. Thank you.
Thanks, everyone. And yeah, thanks for listening.
You're welcome. Okay, so we are coming up for our final presentation of today's event, and it's Solomon Global. It specializes in the supply of LBMA approved gold bars and coins. LBMA being the London Bullion Market Association, approval at its highest level. Paul Williams is the managing director. He has followed gold's performance throughout his career. We just need Paul to click on his microphone. We can see you, Paul, and just want to hear you.
Okay.
We've got you.
Bear with me. Oh, you got me now, have you?
Yes, it's good to see you. So the floor is yours.
So have I got, well, thank you, Sarah, for that. I'm not sure how much time I've now got. Obviously, listening to my fellow presenters was really interesting, very technical. So we're gonna focus on a simple presentation here, which hopefully everybody will understand. When I left home this morning, I think it's worth mentioning, my wife, instead of saying to me, "Good luck, hope it goes well," she reminded me of the time that I presented my father of the bride speech at my daughter's wedding, and basically said, for God's sake, make sure you keep to your notes. Please don't go off track, because obviously people will want to know about gold and not about golf or any number of other areas. So I must tell you that I'm going to be using my notes throughout this presentation. Hopefully that won't ruin it for you, but it does at least keep me on track. So I'll make a start. So I'd like to thank obviously the other fellow presenters for explaining why gold is so special. That means I don't have to, and I can really focus on what we do here at Solomon Global and the value that we offer, we believe, to our customers. I think for a bit of context, it will be worth me just giving you a brief insight into my career. I think it's relevant because it's influenced the way in which we work in Solomon Global and how we view ourselves in the gold industry. And unfortunately, it's quite a long time ago. And anybody who's getting to the other end of their career path will know that it goes very quickly. So I started off my career in the building industry as a quantity surveyor, which I thought is the area I was going to stay in. Very quickly, I moved into the financial services industry, where I've spent over 30 years working with many impressive financial institutions, but then subsequently moving across to build my own boutique IFA, independent financial advisor practice. We gave regulated advice on a full range of products to a complete mix of clients over that period of time. All sorts really. So obviously investment based, but also insurance based as well, as anybody will understand who has got or dealt with their own financial advisor. As you know, financial advisors are trained to learn, understand what their clients want to achieve with their finances, what kind of risks they're willing to accept in order to achieve their goals. I think the risk is a really big factor. It's hammered into us in the financial services industry that you need to make sure that the client you're dealing with, you're giving him the appropriate, him or her, the appropriate level of risk to what they want to achieve. So everyone is different, and so taking your time and providing a professional service is key. And we did that previously, and we do that now. Despite this part of the role, despite this part of the role being quite straightforward, some advisors are simply better at it than others. This could be because they're better at communicating, or maybe they cared more about their clients and wanted to ensure that they gave them the right product at the right time. This is obviously something that can be trained, and I was very lucky to work with a number of very successful advisors, and hope that I was a good advisor and did the same thing. So once I was clear of the understanding of what somebody wanted, the majority of investments that I advised, I suppose, to people were very good. Some were exceptional, but there were a few that failed miserably. I mean, this could be for a number of different reasons. Could be bad management, obviously unforeseen market conditions. Either way, even complex instruments such as bonds, trusts, pensions, they did completely fail sometimes. And of course, they're still failing today. During my time as an IFA, I have always kept my eye on gold. It's not easy as an independent financial advisor to advise people to invest into alternative investments. IFAs are very conscious of going outside of what they traditionally sell. But the reason a lot do keep their vision on gold is that it regularly bucks the trend. It very rarely seems to fail over any medium to long-term period. Most serious investors don't tend to buy investments for the short time or short term. Usually you'd find that it's 5 to 10 years. And what we believe, and has been shown in the presentations so far, is that gold's performance over any 10-year period has always been extremely competitive. In fact, we believe the same is probably true over most 5-year periods. At Solomon Global, we have developed a business, we believe, that learns from the regulated financial industry. We're not regulated at the moment, although of course that may well change in the future. And we founded, or based our business on providing a service to our customers where we can offer them the chance to own physical gold, not shares in a business or a structured product that has an interest in gold. Although already there are quite a few people here, I think, that will be interested in TallyMoney, which obviously ties in very closely to what we're doing. Our customers physically own the gold that we sell and can decide what happens to it, whether they wish the gold to be held in a professional storage facility, which we can help them organise, or kept at home in a safe, or underneath floorboards or in the back of a cupboard, if that's what they wanted to do. It's totally the customer's choice, of course. And as the gold is in the customer's ownership, it is, as mentioned, 100% in their control. And I think that's really important. We believe that's an important part of why people want it. We are finding that hundreds of our customers who want to have as much control of their finances as possible, and owning physical gold allows this to happen. Our customers can buy and sell whenever they want, of course. Perhaps more importantly, when gold is held over a medium to long term, it has always gone up in value. Gold has, as far as we know, always been in demand since recorded civilization began. And since there is only a finite supply, again, as far as we know, gold is one of the safest assets to own. Most people agree that if you own gold, you should make, and I think this is backed up by, again, what's previously been said, that most people would expect to make around 9 to 10% per year over a medium to long-term period. There are lots of very smart people and financial institutions at the moment that are broadcasting that gold is at the beginning of a long-term rally. Many suggest that due to the cost of the pandemic that has not been paid for, years of fiscal stimulus that has put all Western economies in tens of trillions of pounds of debt, wars and conflict escalating around the world, and an overdue correction in the economy, it is more predictable than ever that this instability and set of circumstances is going to drive gold and gold's demand and value through the roof. That's
Now,
what we,
Paul,
yeah.
we haven't yet moved on a slide because we're waiting for your cue.
We're
Should
going on to the slides now, if you want. I'm
Thanks.
ready for it.
Thank you.
So, I might not have a lot to say on the slide, Sarah, so that might go very quickly. First, I just want to make it clear that we offer individuals at any scale a safe and simple method of being part of the gold market. So, yeah, right, we get on to the slides. So about Solomon Global, wealth of experience. We have 20 staff that come from a variety of backgrounds. All of my colleagues are really happy working solely with gold. And I think that's because they feel that they can completely rely on gold continuing to deliver the benefits it has done historically. We believe we offer a bespoke investment service. That's because we pride ourselves on providing a service that customers feel that they are understood. Any offers we make are in line with what our customers have shared with us. So we sit down with our customers and make sure that they are getting what they want to get. Unrivaled access. Now, this is mainly because we purchase such large amounts of stock from the Royal Mint on a regular basis, on a monthly basis. This is obviously for our customers, and this gives us first refusal on the limited stock availability, which in turn, obviously, we pass on to our customers. We've got competitive rates. Again, this is down to the amount of product that we purchase. We can be competitive because our model is based on economies of scale, and we pass this on as much as possible to our customers. Always happy and able to buy back. Now, what this means is that when we first start talking to our customers about whatever it is that they require, we look at we make them aware that we are keen to buy back the gold when and if they want to sell it. So a lot of customers are keen to buy and buy and hold, but are not really sure what to do, and would be, I suppose, they would be worried that maybe they wouldn't get the best price, or they wouldn't know where to go. So we offer them the option that if they get to that point and they want to sell their gold for whatever reason, that we want them to come back to us first. It's possible we might not be offer them the biggest price, and there might be somebody else, but we will definitely help them to do that. So if you want to go on to the next slide, please. Right, let me just move this. So what we're going to do is look at the physical gold options that we sell to our clients. So have you got the, you want to sort of go up slightly to the first one. So bullion, gold bars. Traditionally, we believe this is the most popular route to owning physical gold. And I mean, you can read the slide yourselves, but obviously investments are subject to capital gains tax on this, and that's relevant later on. Low premiums. We obviously will sell our gold bars at the nearest price we can to spot price, which is the rate that gold is offered at across the board. It's VAT free. Obviously, as mentioned before, it's easy to store, and as I've just mentioned, flexible to sell. That again, we would be very keen to get involved in that and help them. We believe that the average return on a bullion gold bar would be somewhere in the region of 8 to 10% growth per annum. and I was in the financial services industry, if I could have predicted a regular return of 8 to 10%, all of the clients I would have dealt with would have been very, very happy. I think the only product we thought might have done that was property, and it didn't. Indifferently, it did for periods of time, but then didn't. Gold coins. Do you want to go on to the next slide, please? So, gold coins are we believe, an easier purchase for new clients to us. All the benefits of owning gold bars, plus there is a greater collectability, and as we'll chat through in a second, it's even more tax efficient. So additionally, there's a demand from gold collectors markets. Now, this market is growing, which is good. It's currently valued at $15 billion a year, but it's expected to rise. So people buying gold coins, which would be loose gold coins, they are in a market that is going in the right direction. And as mentioned on the slide, because coins are considered British legal tender, they are also CGT or capital gains tax free. So it's a really positive way to get into investments, and has all the attractiveness that an advisor would, if they were selling you a pension, would push you towards all the tax advantages, and gold coins have tax advantages as well. Again, we would suggest that the average return is slightly higher, 10 to 12% per annum, we would estimate. Next slide, please. So this is an area that we do a lot of with our clients. We believe there are large advantages to the right client to own graded gold coins. Again, as on the slide, it's ideal for investors looking to achieve the maximum returns from limited edition coins. All the same benefits as owning bars and previous loose coins, but with a larger demand from the coin collectors market if your coins are at the very top of their level or their authenticity, etc. What we do with the guarantee, we guarantee authenticity and the condition. A graded coin, effectively, that we offer has been independently verified as pure, authentic, as a limited edition. And what this does is it gets them more in demand, and hopefully makes our customers more growth. I mean, obviously, sad times like the death of the Queen, a new king. Those are areas that people who have been lucky enough to get hold of the graded coins that were produced at that time, we would expect they would get very, very good returns on that. Creating even higher demand and above premium yields, and that is really down to the limited amount of coins that are available. We think the average returns because of this could be significantly higher, and what we've seen is growth of between 18 and 22% on an average. What we do is that we mix and max the graded gold coins, gold bars, and loose coins with a client depending on what they require. So they wouldn't necessarily get one or the other. It depends how long they want to hold. If they wanted something that was long term, the graded coins would be perfect for them. But if they at the same time thought that within a short period of time they needed to access some capital, then we can give them a mix and give them some of the other type of investments. Next slide, please.
You've got 2 minutes left, Paul. 2 minutes.
Great. Okay. This really is just, I think we should move away. It just shows the 10-year gold price, which is obviously going in the right direction. And I think anybody that's been on this can access this sort of information. So just pass to the next slide, please. So we are very proud of our customer service. We've done extremely well. We work really hard to make sure that our clients and customers are happy with what they get. We encourage people to come and meet us if they can. if they're not too far away, we're in South London. I think customers want to know that you genuinely care and that you're offering them a value beyond the cost. We try to do that. Obviously, we can't do that with everybody, but we are very proud of our customer service, and we will continue to concentrate on that as well. Final slide, I think. So obviously, you'd be very surprised if we weren't keen to take new customers on for our service. And obviously, what we're doing is we're happy to offer a discount to anybody listening. There's a discount code which is at the bottom of our presentation here. And if somebody wanted to consider purchasing, they can either telephone us and have a chat with one of the consultants here who will go into more detail, look at what they want, or they can buy off our website. So it's, obviously we're looking for new customers. We think it's a great time to get into gold, as been explained by all the other people today. And yeah, so I think that's about it, Sarah. If there's anything you want to ask?
Well, Paul, thank you very much indeed. I can see why you're so cheerful. So what your presentation actually didn't have, which I've seen because I went onto your website yesterday, are all just rows and rows of bullion bars and coins, and they are things of exquisite beauty. So I'm just wondering, it's an unfair question and you might not know the answer to it, but what is the most valuable coin that Solomon Global holds, and has it made an appearance on the website yet, or has somebody already bought it?
Yeah, very good question. Thank you for letting me off the hook if I needed to get off the hook, Sarah. What we do is, I think if you looked on, if anybody looked on the site, there's loads of examples of the value of different coins. I mean, what tends to happen is the most valuable coins do get sold very quickly. Yeah, I think that it's a difficult question in so much as I couldn't really ask or tell you what's our most valuable coin, but people should phone and have a chat with our consultants, and then we can actually put them in the area as to what's available. I mean, because we buy we buy direct. We obviously, there's different things coming up all the time. So coins do change in value, and obviously on the graded side, which are our most expensive coins, it's really designed on how pure they are and how clear the print is, etc. That actually makes a difference.
And it's good that you reminded people that holding physical gold, the bullion bars and the coins has capital gains tax benefits. So I'm going to be on the phone to my dad.
Well, I think just on that, on the financial services, over the years that I was involved in it, one of the things is that nobody ever really can touch anything that they buy. The only time life assurance is useful is, unfortunately, when somebody needs it. A pension, that's at the other end of the scale when they want to retire. But you can't touch anything. But the coins, you're quite right, the coins that we sell, they're beautiful. And if you get one in your hand, they really do look, it's worthwhile. They're heavy, but they're a very beautiful item to own.
And I look forward to when one will be resting on my palm. Thank you very much, Paul Williams. It's been an absolute pleasure. And thank you for giving our forum, our community, a discount code. We really appreciate it. Thank you.
You're very welcome, Sarah. Thank you.
Thank you. Right. So I'm going to invite Lord Ashbourne back into the room with me, please. Lord Ashbourne was the scene setter for this webinar. So you've listened to two companies, two explorers, and we've got TallyMoney, and we can actually have the gold bars in our hand. So really, gold isn't boring at all, Lord A, is it?
No, whoever thought it was? No, it's fantastic. I mean, both, for its tactical and tangible sort of qualities, but also for its investment qualities as well. So, you're really not getting everything, but you're getting quite a lot of what is nice to have in one place. So, I like it.
So I think that part of this, there was a question sent in before the webinar are. What is the best and safest way of investing in gold? Are ETFs a sound and secure way of investing? Well, obviously, we found out that TallyMoney is another way, and actually buying the bars.
Yeah, no, and I think, that's it. I always think of things in terms of, how would you construct a big portfolio? Because that's my sort of mindset. And it's, at the bottom rung, I think, which is the lowest risk. If you like gold, you buy the metal. Now, you can branch out from that, and then you can get, sort of digital derivatives of gold. They carry a little bit more risk, not much more risk, but a little bit more risk. And then after that, I would say you go into what are called the streamers. So you're looking at the Franco-Nevadas, the Wheatons, and they give you very good overall exposure to gold and precious metals, I should say, because there's quite a lot of silver in there as well. They also give you a geared effect. They also give you exposure to blue sky, and they also give you a dividend as well. So they give you, and then a little bit more risk again. You're probably looking at the producers, a little bit more risk again, and you're looking at the juniors. So, but lowest risk. It's buying the metal, or possibly an electronic derivative of that.
So Stuart is waiting patiently for you to answer this. Is there an indication of expected time for gold to rise to your indicated level?
No, I think is the short answer of that. Like all investments, it can go up and down, but not necessarily in that order. And gold it's quite susceptible to the macroeconomic pronouncements, particularly by, at the moment, the Federal Reserve. So, the Federal Reserve come out and say something particularly hawkish, it usually has a dampening effect on gold. And if they say something slightly dovish, it has the reverse effect. So, look, I think that where we are, I think is roughly akin to September 1979. So actually, in my opinion, we're looking at months, not years, in terms of gold hitting those sort of peaks. In the same way it peaked in January 1980. So, what's that, 4 months away from September 1979. If you're looking on a month by month basis, it was more like July, August 1980. But, months, not years. But, as I say, we're in an uncertain world. If it turned into, 13 months, then come back to me. You said months, not years.
Tom Daniel asks, and you might not be able to answer this, I don't know how regulated you are, but Tom asks, what is your favorite dividend-paying gold stock?
Gold stock, I mean, this goes back to, how you construct a portfolio. So you're looking at the dividend payers. I'll give you a few, just not the only one. But Wheaton is a very good one. It's a streamer rather than the producer. Agnico I like. And if you want a smaller one that's traded in London, is Pan African Resources. It has a very decent. It's about 3.1% yield at the moment. So there are three to choose from.
So you and I are here as ambassadors of the gold sector, but I've had a few questions. What would we say to those who say, are tech companies and the data collectors really the new gold?
No, they definitely aren't. They're something totally different. And it's about which I know very little, by the way. So I should put that out there. They're definitely not the new gold. No, even Bitcoins are not the new gold. Gold is something old, something traditional. It's something that has a fundamental store of value. But essentially because it's rare and because people desire it, and because it's held as a monetary asset by reserve banks. So if it doesn't have any of those sort of qualities, then it's not like gold at all. And so tech stocks, they have value, and can that value go up? Yes, but that is going to depend on their product pipelines, their product development, the sales they make in the future. It's got nothing to do with intrinsic value, and that's what gold has. So no, I wouldn't say that they may be good investments, tech stocks, but they're not at all the same sort of investment as gold is.
finally, let's talk about the vibe, because obviously you have access to the House of Lords, you have access to your peers' brilliant analytical brains. And then we've got Alex from Barton Gold, who's at a conference, and he said that the energy is palpable. There's green shoots of recovery in the market as a whole. So what's the vibe like amongst your network?
Yeah, no, I think I'd echo that, because, you know, the network that Alex is in and the network that I'm in are not very dissimilar at all. And, you know, in an extremely uncertain world where gold has gone up from, you know, 19-ish $100 an ounce, what, 6 months ago, to you know, 2,300 now, there is definitely a feeling that, you know, what is happening is a positive and exciting thing. And there's also, I think, a growing feeling that what is happening in the real economy, by which I mean with particularly US dollars, US debt, the global geopolitical situation generally, and the relationship between China and the US is a dangerous thing. You know, there are difficult tides in the world as we see them now, and that has conversely got to be a good thing for gold.
Thank you, Lord Ashbourne. It's been a pleasure. And I just want to thank all our other presenters. I can see that Cameron's there. Cameron, thank you very much indeed for giving such a generous offering to the Master Investor audience for TallyMoney. Really good luck with that and your strategic ambitions. I also want to thank Paul, who so cheerfully told us about coins and gold bullion, and of course Alex. And we also very late on James Churn's side. I think it was 1 o'clock in the morning where he was when he was speaking to us. So thank you very much indeed. I just want to say thank you to my events director, Sophie, the chief executive, Tim Corcoran, chief commercial officer, Amanda Taylor, Leo, Andreas, the rest of the team at Master Investor. And I just want to tell you that we have a couple more forums. The 5th of June, the Small Cap Award nominees, the leading lights of Aquis. And on June the 19th, we have a webinar, which is our oil and gas focus. Lots of webinars to look forward to. And of course, it's not too early to enroll for the Master Investor Show next year. Thank you very much indeed from me. It's been a pleasure.